Hi, I'm Paul Kerbo, lead investor of the Flourish Fund. I want to thank everybody for being here. I'm going to start by describing why I started the Flourish Fund, our investment thesis. It started in 2015. I was at an investment conference when Finney Curavella, co-CIO of Eventide Funds, gave an important talk. He spoke about how investing means ownership, and that if we own stocks or own part of a business, we profit when that business makes money. And do we own things, frankly, that we're proud of as investors? He talked about this company, Philip Morris International. You may be more familiar with their popular brand, Marlboro. They are the owner of Marlboro outside of the US and responsible for a lot of tremendous growth. And their business is essentially getting kids or young adults addicted to tobacco. And in short, I asked myself, did I invest in a company and did I profit from a company that got kids hooked on cigarettes? Was I proud to own this business? And in saving for my own children's 529 plan or my own retirement, was I profiting from a business that sought to exploit children, leave people weaker, sicker, or made our world worse? I looked through my investments, and I think if you look through yours, I did own Philip Morris. And if you own an S&P 500 index or ETF, you do own Philip Morris as well. And it also pays a great dividend yield. So it's owned by a lot of income-oriented funds. I started to research this issue, and I learned about two methods that people use to incorporate their values into investing. They use negative screening, where you can find funds that eliminate certain stocks, things that don't agree with your values. Again, that's called negative screening, and there's nothing wrong with that in principle. You can also use positive screening, which is where you make investments in things that support your values. And we've seen a lot of that with younger investors wanting companies to support their values. And again, there's nothing wrong with that in principle. The problem with both approaches is that it's really hard to do in reality. You have to be able to precisely describe your values, and then you have to find an investment product that reflects that. Now, the investment management industry is smart. They know that this problem exists, and they want to serve your desire for good. So they've created various funds and ETFs. By using our desire for good, they manufacture a product that on the surface tries to deliver that. Here you can see the Dow Jones Sustainability Index. It uses ESG criteria, which stands for environmental, social, and governance criteria, to select stocks to put in a index or fund. Now, this combines both negative and positive screening in some sense, but in reality, ESG fails. When we look at ESG, we can see that the Dow Jones Sustainability Index in North America recognizes, once again, PMI's sustainability performance. PMI is Philip Morris International. It turns out that tobacco is a very sustainable business. And smart businesses can game the system to be included in all kinds of indexes, funds, that I think if you asked a non-investment person, they would respond with an answer that, no, this is not the kind of company that I intended to invest in. So ESG has a good mission, but I think it can be quite flawed in practice. And something ESG does not do is look at the business mission and see if it solves any problems. Instead, it looks at the company's reporting of data and rewards companies that report a lot of detail and make progress towards some goal. But in reality, the business's mission itself may be harmful to the world. Okay, let's take a step back. Everybody wants a world that is better, a world that we would characterize and describe as one marked by human flourishing and strong community. Human flourishing would be making people better, smarter, healthier, having more enriched lives. I think there's also the recognition in terms of community that we live in a world and in a country that's so divided politically, socioeconomically, geographically, racially, that anything we can find that brings people together, I think, is an important attribute to have. We also, as investors, want strong returns. Now, are those objectives mutually exclusive? They shouldn't be. And I've been studying this issue and this problem. And I think I can help because I actually think strong returns can be gained from solving our biggest problems. As I mentioned, I'm Paul Kerbo, and I have 25 years of investment experience. I recently retired as a senior portfolio manager at Invesco, managing over $20 billion. I'm an executive in residence at Georgetown University. I'm the CEO of Kerbo Advisors, a consulting firm for public and private companies. And I've also been fortunate to have some nice media appearances over time. I have experience in investing at a very high level, and I've been doing this for a long time, but I've decided now is the time to bring this investing focus to venture capital, where I look to find opportunities for investment in companies that are solving big problems. Now, I view the Flourish Fund as my calling from God. So there is a faith component of it for me. As a Christian, above all else, I am focused on loving God and loving others. And this opportunity to intentionally invest in excellent businesses that care for people well is perfectly aligned with that identity. Now, we don't require companies that we invest in to be of a particular faith or to have any faith at all, but we do require the founders to be on mission. Now, what we're doing is unique. Most investors look only at the financial rewards and not the impact. Two major questions that I'd like you to ask yourself. Number one, are your investments helping or hurting? Number two, do you have any investments that are solving problems? I'm not talking about charity. I'm talking about investments that you expect to make money on. If your answers to these questions are, I don't know, it's okay. You're exactly where I was in 2015. And I would invite you to move beyond the simple concepts of positive or negative screening and instead consider dedicating a small portion of your portfolio to companies that are solving problems and making the world a better place. I think the reason why this is so challenging is that there's a tremendous disconnect between the problems that we face today and the kinds of companies that are in the stock market. Think about the problems that we face. There are educational challenges, massive inequality, climate, environmental challenges, more difficult healthcare issues, loneliness, mental health. What companies do we see in the stock market today? I mean, the largest companies would be Apple, Microsoft, Amazon, and Google. And a lot of the companies in the stock market are focused on entertainment, our comfort, and productivity. And there's nothing wrong with those things individually, but at some point, capitalism and our investments, at least at some level, should be working to solve problems that we face. And I believe that if the problem is big enough and the solution strong enough, there are significant returns from building companies that solve the world's problems. We need to return to looking at the stock market or the companies we own, not as disconnected from the world's problems. Instead, at least some of the companies we own should be solving problems. And some are, but not nearly enough. And that's partly because we as investors are not demanding them to do so. Instead, we just want them to go up in value. We need to bring the focus back on using people and capital to solve our problems. If we look back in history, inventors and entrepreneurs have solved a lot of problems. We just forgot about them. One example is food. Now, I could have picked a lot of things: sanitation, water, transportation, communication. But imagine you are in France at the end of the 18th century. An ordinary family spends about half of its money on grains alone. You would have a bowl of food that you would pass around the family, and you would all eat from the same bowl and lick the spoon clean. And that was in good times. In times of a bad harvest or famine, some would resort to cannibalism, but most would die of starvation. Up until the middle part of the 20th century, famine was a regular phenomenon. And from 1900 to 1909, 27 million people died in famines, and more than 15 million people died every decade from the 1920s to the 1960s. So to combat this, people and capital came together to address this problem. 150 years ago, it took 25 men all day to harvest and thresh a ton of grain. With a modern combine harvester, a single person can do it in 6 minutes. That's a 2,500-fold productivity increase. And we're much more productive with the land that we're using today. You can look at this graph in terms of the increase in grains or cereal production over time. in comparison to the population. And you can see that there's been much more significant growth from 1961 to 2021 in terms of production of grains and the yield that's produced. The land that's actually used has grown a little, but not nearly at the same rate. That's in the bottom line here. So through the productivity improvements like drip irrigation, the kinds of plants or crops that we're planting, synthetic fertilizer, a lot of improvements have been made to increase the yield from farming. Now, some of these improvements have also resulted in other environmental problems, but that's just another problem to solve. And that's my point, is that the world's problems don't just solve themselves. They aren't solved by complaining about them. They are solved by problem solvers backed by capital. And it's our belief that they do that by building scalable and repeatable businesses. And we think by investing in these scalable and repeatable businesses at an early stage, that can result in great outcomes for investors and for society. And I believe that startups can solve these problems better than large companies. Large companies have so many demands, so many constituencies, be it boards, workers, customers, quarterly earnings, lots of things that demand their attention. But a startup begins with an idea, a solution to a problem. And with the Flourish Fund, we're just making sure that the problem being solved is something that adds to human flourishing or strengthens communities. Now let's talk about startup or VC investing a little more. You've probably heard that only a small percentage of startups succeed. And you've heard that because it's true, but it's also true about the stock market too. In a study of 100,000 private market investments, only 4% of early stage startups succeed. So that's also the best time to invest, because if you can pick those companies when they're very young, they're going to grow exponentially and you're going to have very significant returns. But the failure rate is high. Now in the public market, from a study done from 1990 to 2018, only 1% of firms actually accounted for all net global wealth creation. So both in public and in private, very few companies succeed and create most of the wealth. The public market does have the benefit of you being able to invest through an ETF or an index or a fund and get much more diversification and have a chance of owning at least the winners. But in private investing, if you can bring down how much you have to invest, which we do with the Flourish Fund, you can create a much more diversified portfolio very quickly. This gives you a better chance to have exposure to the winners. So how to improve our odds of success? My experience, I've talked with hundreds of management teams over my 25 years. I think I know the common traits of successful entrepreneurs. We look for entrepreneurs with a secret or an advantage. Maybe it's their product, their background, their connections. We look for them to have multiple exit or capital options, not just an IPO, but perhaps franchising, perhaps other strategic investors, moderate use of debt, plenty of options. One thing about investing is that there are investment herds. And in VC, people tend to follow people that have had a successful investment in the past. But I can tell you that the past does not necessarily represent the future. And I've seen that countless times in the public market. So we aren't contrarian to be contrarian, but we look for businesses that have a specific set of criteria that I will describe in more detail. We also think we improve our odds by allowing our investors to write smaller checks. So you improve through some level of diversification. We interact with, in some way, about 750 to 1,000 startups per year. Deal flow comes from our angel networks that we're a part of and other sources. We perform due diligence on roughly 250 to 300 startups per year. And we plan to invest in roughly 10 to 20 startups per year. In terms of our due diligence, we score each company that undergoes due diligence with ratings for both business and impact. For business, we examine product, market, deal, and team closely with numerous questions and follow-ups. So for example, like product, we're going to look and see if there's moats around that product, what network effects might exist. Is there something proprietary about the product? Are they gaining traction? Do they have good sales, good numbers? Do they have some kind of secret, as I mentioned before? And then are there economies of scale? For impact, we screen closely on mission, impact on the world's problems, and the company's impact on its stakeholders. Nearly all of our investments will serve to meet one or more United Nations Sustainable Development Goal, which is a blueprint for a better and more sustainable future. So things like good health, quality education, gender equality, sanitation, our companies would meet one of those goals or try to achieve one of those goals. So when we look at the industries that we'll invest in, we look at the problems that we face. So problems that I described before would be things like health and education, wealth inequality, climate and environmental change, loneliness, mental health. So we're looking for excellent businesses that are working on solutions to these problems. Examples would be bringing software and technology to healthcare, would be producing climate data, perhaps a fintech that's designated and targeted towards underserved communities, training of the workforce. We're focused big picture in terms of industries like software, data, online communities. We're not going to be so much focused on things that are more product related. So things like robotics, consumer products, or biotech. These may serve our mission, but we're unlikely to be the best investor for that, given the experience one probably would need. And my long-term vision is that we'd have 10,000 investors using their capital for good. Our approach would no longer be unique, but common. And for you as an investor, success would be that you would be able to see the connection between your investments and how they can help solve the world's problems. We take comfort from the Bible in Isaiah when it says, "The desert and the parched land will be glad. The wilderness will rejoice and blossom like the rose. It will burst into bloom. It will rejoice greatly and shout for joy." And that's our vision, is that what we're doing will actually result in flourishing, that the investments we make, the time we spend with companies, where we're putting our capital and time will actually result in flourishing in the real world, and hopefully be something that we'd all be proud of in terms of our investments. I just want to summarize what we've discussed here today. In that, it's not a surprise, our world has problems. Just read the paper and you're not surprised by that statement. The question for you, though, is do you own any investments that are going to make the world better? And I'd like you to take comfort from the fact that there are companies out there that are trying to help and are building excellent businesses. So all hope is not lost. There are businesses that are doing some good things. I'd like you to look at your own portfolio and see if you have any investments that are solving problems. You are an owner of those investments. So what problems would you like to solve? And I would encourage you to diversify and not just focus on only one problem or only one company. And I believe that you can make profitable investments that will seek to create solutions, companies that you would be proud to own and excited to see the impact that they can make. But the most important thing is our feedback form. If you have problems with it or the QR code, just send me an email at theflourishfund@gmail.com, and I will send you the questions that we're asking. Again, we'd love to know your interest level, and I'd love it if you're able to help share our strategy with others. Thank you very much for your time. Really enjoyed it. I hope it was worth your time. Thank you again. Goodbye.